Imagine saving tens or even hundreds of thousands of dollars, not by flipping homes, but by understanding how to file your taxes.
And the way we can do that is through a cost segregation study where we come into the building and, just as the name implies, we segregate the cost into different buckets.
Real estate investors are playing by the rules, and they're using those rules to wipe out entire tax bills. In fact, it's so effective that it feels like stealing, but it's exactly what the IRS wants you to do.
You've probably heard a lot about it in the news lately. It was reinstated as part of the One Big Beautiful Bill that was passed in July.
We're speaking with Erik Oliver from Maven Cost Segregation. And if you've ever bought a property or plan to, you're going to want to hear how real money gets made before your first guest even checks in.
If I do a cost seg study on those long-term rentals, I can create a huge deduction. The problem is that deduction cannot be used to offset my W.
I'm Jason Muth. I'm a 35-time Airbnb superhost. After 25 years working in the media business, I started building my Chapter 2 through the world of short-term rentals. Since then, I've hosted over 7,900 guests and their furry friends, and now we're managing more than $42 million worth of vacation homes, including the ones that we own and the properties on behalf of our 33 clients. This show is all about helping you create a smart stay, personal, profitable, and built to last. It's real-world hosting done smart. Let's go. So, Rory, as real estate investors, I was trying to think of my favorite two-word phrase as a real estate investor, and one might think it's cash flow, but I think bonus depreciation is up there, and I think cost segregation is up there as well. What do you think?
I mean, you can't have one without the other. I mean, I suppose you could, but it's not really the same. So if you're in this context, they go together like peanut butter and chocolate or peanut butter and jelly, and it's something that that everybody should know about. And I know every year it changes just a little bit in its application, but it's a concept you should understand if you're getting into the short-term rental space. Everybody should understand it.
So recently, well, like a year ago or so, we had Sean Graham from Maven Cost Segregation on Smart Stay Show. And then somewhere along the line, I saw that our friend Erik Oliver joined Sean with Maven, and we reconnected with them a couple of weeks ago. And we are grateful to have Erik here on Smart Stay Show to talk all about tax savings, cost segregation, bonus depreciation, and all that fun stuff that people in our space know about, but people outside of our space have no idea what we're talking about. So Erik, welcome to Smart Stay Show.
Thanks guys for having me. I'm glad to be here.
We love seeing Erik because he brings money with him, right? Like he doesn't know it, but he shows us ways that we can offset, defer, push forward some of our gains in the form of, recouping depreciation through some of our properties. And I just learned another term, the poor man's 1031 exchange, which we're going to get into on this show because apparently that's what we're doing. I don't know if we're the poor men. We might be the poor men, but we're definitely doing a poor man 1031. That's for sure.
We're doing a poor man's reverse 1031 exchange, actually, if you really want to get into that.
All right. So I had my terminology wrong, but dating back a couple of years ago, the reason that we even know Erik is because I saw him speaking at Bigger Pockets conference many years ago, back in 2022. And I immediately called Rory after his session and I'm like, we're doing it wrong. Or I found something that we need to be doing. Like, I think we qualify as this. I think we qualify as good W-2 earners who also file as real estate professionals. And we haven't done any of these cost segregations on our properties yet. Like, what on earth are we doing? Why are we waiting? So we contacted Erik. We had him on the podcast. We had him do a cost seg for one of our properties, which we'll get into. And we were able to maximize our savings that year many years ago. Erik, let's start by you just explaining to people that are listening, maybe for the first time, what is the easiest elevator pitch on what cost segregation is and what does bonus depreciation mean?
Yeah, those are two good questions. So let's start with cost segregation. Cost segregation really is just accelerated depreciation on your real estate assets. So one of the great benefits of owning real estate and why a lot of us get into real estate is for some of these tax deductions. And one of those deductions is depreciation. And the IRS has set forth kind of two guidelines. One is residential properties depreciate over 27 and a half years, and commercial properties depreciate over 39 years. So just to make the math easy, let's say you have an office condo, you bought it for 390,000, you take 390,000, divide it by 39 years, and essentially you're getting a $10,000 write-off against your income every year. Now, I've oversimplified that a little bit because land is non-depreciable, so you always have to back out your land value. But that's the idea. It's just straight line depreciation. You take your building's basis, divide it by the number of years you're depreciating it by, and that's your write-off. And that's what a lot of investors do. Again, that's called straight line depreciation. Cost segregation is, you know what, I don't want to wait 39 years to depreciate my building. I'm not going to own it typically for 39 years, and I want my deductions now. And the way we can do that is through a cost segregation study where we come into the building, and just as the name implies, we segregate the cost into different buckets. And what that allows us to do is front load or take our depreciation at a much faster rate. So to give you an example, let's say you buy a short-term rental. A short-term rental has carpet. It's got appliances typically. It's got a driveway. It's got a fence. It's got retaining walls, irrigation, cabinets, countertops. All those things I just mentioned, the IRS says those things don't last 27 and a half or 39 years. Carpet, for example, lasts 5 years according to the IRS. So we should be depreciating our carpet over 5 years. Now, the problem is that when we buy a short-term rental, let's say we spend $500,000 on a short-term rental, we just take our closing statement, we hand it over to our tax preparer, and our tax preparer has no clue if there's carpet in that building or what the appliances are, or even if they did know there was carpet, they would have no way of valuing that carpet. So just as the name implies, we segregate the cost. We take that $500,000 purchase price and we say, okay, of that $500,000, your cabinets were $12,000. Your parking lot or your driveway was $80,000. Your appliances are $17,000. We segregate and put values to the different components. And now we get to depreciate our carpet over 5 years versus 27 and a half or 39 years. So that wasn't quite an elevator pitch. That was a little bit longer than an elevator pitch, but cost segregation can get a little complicated. So that's about the shortest pitch I've got. Now that's cost segregation. Your second question was bonus depreciation. Bonus depreciation goes hand in hand with cost segregation, and it essentially puts cost segregation on steroids. So bonus depreciation has been around for a number of years. It's kind of how the government uses bonus depreciation to stimulate the economy. And quite honestly, I think when bonus depreciation first came about, they weren't even thinking of real estate, because one of the rules of bonus depreciation is your asset has to have a useful life of 20 years or less to be eligible for bonus. And naturally, real estate is 27 and a half or 39 years. So there's even tax preparers I talked to today who are like, yeah, you can't take bonus on your real estate because real estate's 27 and a half or 39. And in order to take bonus, it's got to be 20 years or less. And I come back to them and say, well, yeah, you're right. But if we do a cost segregation study and we go into the real estate and we find all the 5-year stuff, all the 7-year stuff, and all the 15-year stuff, well, all that stuff is under that 20-year threshold. So now we can take bonus on all that stuff. So, but again, bonus has been around for a number of years. You've probably heard a lot about it in the news lately. It was reinstated as part of the One Big Beautiful Bill that was passed in July. And so we're back to 100% bonus. So what that means for investors is when you have a cost segregation study done, all of the stuff that we find in the 5-year bucket, instead of depreciating that over 5 years, which is good, we now get to take 100% of that all in year one. 100% of all your 7-year assets and 100% of all your 15-year assets. So again, it's a great time to be a real estate investor. If you own real estate, you should be paying very little taxes with some of the laws that are now in place.
Yeah, so you're really pulling this forward in a way that a novice might not realize is even allowed. But I've been reminded many times this is the way the tax code is written, right? This is what we're supposed to be doing. This is what the IRS wants us to do. When I first heard about this, I felt like I was stealing. I was like, wait, what can I do? I could pull all this forward and we could take this first year. But when you explain it that way, that, bonus depreciation is in place to stimulate the economy, basically a real estate investor is capturing all of this depreciation the first year shortly after they buy a property, and they're able to reinvest it back into that property or reinvest it back into another asset, which can then, have a trickle down stimulation for the economy, whether it's providing lodging for people, who are coming to an area that are going to spend money locally, or, the ancillary, people who are working on the property, whether they're plowing it, mowing it, cleaning it, and, fixing the siding and doing that. It frees up all this cash for somebody to be able to do improvements on that property and make the property even better. I've thought about it morally and, realistically. And my hunch is people aren't just taking the money and going to the casino with it, right? Maybe
Right.
some of them are, but the smart money wouldn't do that. The smart money would reinvest it into the property. Now, Rory, you have been involved in our taxes for a number of years now. So you actually saw the effects of the first cost segregation. How many have we done? 2, 3? Your microphone's off.
You're putting me on the spot. I think it's we're third or fourth for our cost segregations. One of our short-term rentals was purchased before bonus depreciation, so that's just been on that's the sole one that will be left on the regular depreciation table. But otherwise, we now will have cost segregated all of them.
Yeah. And frankly, we could explain a little bit about why we did this. Back in 2022, when my job ended, I had half a year of W-2 income with taxes withheld from it. We purchased an expensive property later on that year as a $900,000 property. And we were able to pull forward how much depreciation? A few $100,000 on that one?
That was about $300,000 or $400,000, in large part because we had really extensive landscaping and exterior work that was done.
Yes, I did not realize that the landscaping and the long driveway and retaining wall were all part of things that we could, bring under 5, 7, and 15-year schedules. But according to Erik, they were, so we did. But that year, we were able to offset a lot of the taxes that were withheld from my position as a W-2 employee, and then we were able to, realize some paper losses that allowed us, to get a big return that we then reinvested back into the property that year. Now, when we did that, we got addicted to cost segregation, and we did it with our other properties as well, right? And because we saw this as an opportunity that was written in the tax law. I think it was still 100% bonus depreciation that year, or maybe 80% that year.
Yeah, 2022 would have been 100. Yeah.
2023 was probably 80, right?
80, correct. Yeah.
Yeah. So then, if you're listening to this, it was stepping down from 100 to 80 to 60 to 40 to 20. And I remember seeing on all the blogs, a year or two ago, where there were rumors that 100% was going to come back, but Congress was stalled and nothing got passed through, the House and the Senate. But then last year, as you mentioned, with the big, beautiful bill in the summertime, 100% came back. I think that was during a year that we were in 40%, right?
Let's see, 40% would be this year, so 60% last year.
Yeah.
Is
So
that right?
even 60% is a good amount that you could pull forward, but 100%, it was renewed basically. So 100% is back. That means that Maven cost segregation is going to be super busy this year because everybody wants to do these cost segregations once again. They want to repurchase and reinvest in real estate because now all that depreciation can be taken that first year. Erik, do you think that this actually does stimulate the real estate investment community? I mean, I know people just keep investing whether the rates are high or low, but when you know that you have 100% bonus on the table this year, is that something that might get some investors to actually put their money to work again?
Oh, 100%. Yeah. I mean, our phones started ringing the day after that bill was announced with people who had already bought properties, but then people who were looking for properties to buy specifically for the tax advantage. Now, you don't want to, what's that saying? You don't want to let the tax tail wag the dog. I think that's what it is. I always get it wrong, but
Sure,
you get the
I'll
idea.
go with it.
You don't
Yeah.
just want to buy a property just to save taxes. If it's not cash flowing, if it's in a bad part of town, whatever, the tax part of it should be one piece of it, but it absolutely stimulates the economy with this bonus depreciation. We've seen, and you guys have probably heard, or I've even just listening to podcasts and whatnot, there's a huge increase in short-term rentals. A big part of that, a big reason for that is cost. I'll give you actually a real life example as an investor myself. So I'm a W-2 employee. My wife works in the school district. She's a W-2 employee, and we have long-term rentals. If I do a cost seg study on those long-term rentals, I can create a huge deduction. the problem is that deduction cannot be used to offset my W-2 income. It can only be used to offset my rental income. And my rentals make a little bit of money, but I still have mortgages out on them, and they're not making a whole lot of money right now. And so my problem in 2022 was that I had a high tax bill for my W-2 income. And so what I did is I went out and bought a short-term rental, which is very different than a long-term rental. So a short-term rental, the IRS looks at it like, well, it's not a residential rental. You basically are buying a hotel. As long as the average stay is less than 7 days, which typically it is for your short-term rentals, that's the first test. The second test is that if I can show that I materially participate in the management of that property, then the IRS says, well, Erik, you worked in cost seg, but you also own and operate a hotel business. And because you own and operate it, that is part of your active income. So whatever deductions you create from that, you can use against any and all other active income, which included my W-2. And so I couldn't do that with my long-term rentals. And so a lot of W-2 earners who are having good years or have high income, they're now going out. We see this all the time with doctors or lawyers. They go out and they buy a short-term rental. It's probably their vacation home, if you want to know the truth, but they rent it for a good portion of the year. And then they do a cost segregation study on it. Then they take those deductions to offset their doctor's income. They save themselves $100,000 in taxes. And you know what they do next year? They take that $100,000 they saved and they rinse and repeat. They go buy another short-term rental and they offset their income for that year. And so it's just a great way to reinvest those funds, whether you're buying new properties, paying down your debt. But the short-term market, I think it kind of slowed down there a little bit for a while the last couple of years, but I've seen a huge uptick in the number of requests we're getting for these short-term rentals for people. And again, it's people like me who have W-2 incomes. I'm getting killed on my W-2 taxes, so I got to go buy a short-term rental. And so it's either you're giving that $100,000 to the government at the end of the year in the form of taxes, or you're investing it in a short-term rental, creating a revenue-generating property that's probably going to appreciate over time and create, wealth down the road. And so that's the whole idea there. So yes, that was, again, I'm not giving you a short answer. So that was a long-winded answer to your question. Yes, the bonus depreciation definitely stimulates the economy.
All right. So with the short-term rental piece here, so we're distinguishing it from long-term rentals because they're viewed as hotels, which therefore means it can be used to offset active income. Is this what people refer to as the short-term rental loophole?
Exactly, yeah. And I hate to say that word because you hear loophole and you think you're doing something nefarious, right? Like you're tricking the IRS, but it's actually in the IRS code. And again, it's the IRS. The tax code tells you what they want. The IRS uses the tax code to incentivize people to do what they want us to do, right? And so that's why those rules and regulations are in there, because they do want you investing in these types of properties for a number of reasons. And so, yes, it is called the short-term rental loophole, widely popular nowadays. And as long as you're documenting everything correctly, it's really not a loophole. It's just that you're taking advantage of the tax law the way it's written.
Now, is there or was there ever a limit to the amount of losses that you could take against your active income using the so-called loophole?
Not the loophole. So if you don't use the loophole, let's say I do a cost seg study. So I'm a W-2 employee. I do a cost seg study on my long-term rental. There are some restrictions on how much of those deductions I can use to offset my W-2 income. If you're below $150,000, you can use some of it. Once you hit $150,000, you're basically out and you can't use any of those deductions. So with the short-term rental loophole, no, there's no limits that I'm aware of.
So, again, keeping on this topic, we brought up material participation. Yes. This, I think, becomes a little bit of a hang up for some people. Let me break it into two questions. So if you are involved, but you have a co-host managing some of the day-to-day, do you then fail the test?
The IRS, I wish they did, but the IRS doesn't have a guideline that says you have to do this, this, and this to show material participation. They actually have 7 different tests. You only have to meet one of those 7 tests. Now, do people have companies help host it and still claim material participation? Yes, they do. I think it's a little bit of an aggressive stance. If you ever get audited, it's basically, what is your intent? It's going to be hard. It's hard for me to, I'm in Salt Lake right now. It'd be hard for me to own a property in Florida, have somebody manage it, and then I'm telling the IRS that I actively manage that property from Salt Lake and it's in Florida. I think that's very difficult to do. I've seen people take that stance. I think it's a little bit aggressive. The material participation test that's most often met for these short-term rentals, remember, you just have to meet one of those 7, is 100 hours spent working on the property and more time than anyone else. So in my example, I actually bought my property strategically in September because I wanted to spend 100 hours at the property, but I needed to spend more time than my cleaner, more time than our maintenance folks. And so I did it at the end of the year because I felt like if I did it at the beginning of the year, if I bought in January and we had it booked for most of the year, my cleaner is going to be there quite often, cleaning it, flipping it, getting it ready for the next guest. I may not have been there more time than my cleaner. So I wanted to get my 100 hours in and get more time than my cleaner. And so what I did is I bought it towards the end of the year. Took me a whole bunch of time to get it staged. I was putting furniture together, getting it all ready, put in my 100 hours. We rented it starting in November for a few times before the end of the year. So my cleaner was only there a couple of times. And then the following year, it became too much for me to manage. And so at that point, I turned it over to a management company. But my deduction was created in a year where I managed it, so that deduction was considered active, even though that I turned it over to a management company the following year. But so, yeah, there is some nuances to that as well.
Yeah. So you anticipated the last question I had on this topic, which is if that year that you place something in service for the first time, you likely are doing, a lot of people likely are doing a lot more work, getting it ready and everything. And that's, the other years matter, but that's the year that matters the most. If that's the year that you're going to be claiming the large bonus depreciation in that first year. So it's completely legitimate, even if later on you move it on to a co-host or have somebody else manage it. Now there's so reasons why you want to be materially participate in the future, but that first year is the really valuable one.
Absolutely. And just keep in mind, like, you've got to be, it all comes down to intent. Anytime you're dealing with the IRS, they're going to look at your intent. So if you buy it December 25th, you let your cousin stay there for one time, and then you turn it over to a management group on January 1st, the IRS is going to know what your intent is. They're going to say, you're just doing that so you can get this huge tax write-off. Now, if you rent it out, if you manage it for 8 months, it becomes too much, you go back to work full time, and now you've got a full-time job, and you can substantiate why you turned it over to a management group. You just want to make sure that you've got a legitimate story, because it all comes down to intent, and the IRS is going to look at that. So, you just have to make sure you've got all those bases covered.
One thing I learned when we did our cost segregation studies is that we're not submitting your actual study to the IRS along with our taxes. We're just keeping it in case we're audited as a scientific analysis of the property, or however you might deem it. So we have these, I mean, they're 40 pages long. Each one of them is, and we have it just in case we get an audit. Knock wood, don't audit us, please. But in case we have to, that's when we pull it out. We're not sending that in to the IRS.
Correct. Yeah. Really, and a lot of people think they do. They're like, oh, I got to get this report, and I'm going to have to submit. No, basically, honestly, your tax preparer probably went to the last page of that 40-page report, and on that last page, there's a revised depreciation schedule. So what you typically see when you don't do a cost segregation is you see one line item that says building went into service on this date, and here's how much depreciation I get for over the 39 years. You get 1/39th of your deduction each year. So you just see one line item that says building. When you do a cost segregation study, instead of seeing one line item that says building, you're now going to see 15 line items that are going to say appliances, $8,000, flooring, $12,000, driveway, $50,000. And so that's the information that your tax preparer needs. So they're just going to that last page of our report, uploading it into their software, and splitting everything up into those different buckets. And that's what allows you to realize the deductions. The only time you need to submit anything additional to the IRS is there's something called a look back study, where let's say you bought a property 5 years ago, you didn't need the deductions 5 years ago, but this year you find yourself in a bit of a tax crunch. You can actually do cost segregation this year on that property, bring all that missed depreciation over the last 5 years forward and drop it on your current return. It does require that additional tax form. It's called a 3115. It's kind of an ugly 9-page tax form. If you've ever filled one out, they're not fun. But basically on that tax form, it's interesting because you're actually checking a box on that tax form that says, hey, IRS, I'm going from an impermissible method of depreciation to a permissible method. So you're saying, hey, raise my hand. I screwed up. I was depreciating my carpet over 27 and a half years. You, IRS, tell me in your tax code that carpet is a 5-year asset. So I'm now going to fix it. And here's the deductions that you owe me now. Now, the IRS doesn't come after people if they don't do it that way, but I think we mentioned, or one of you mentioned early in the show, that you're actually doing it wrong if you don't do cost segregation. Because the IRS says carpet is a 5-year asset. You should not be depreciating your carpet over 27 and a half years. Now, the IRS doesn't come after you and say, hey, you're not taking enough deduction. You're letting us hold on to your money for too long. Here, let us give you some money. They're not going to come to you and say that, but you're technically doing it wrong. And that, again, proof of that is when you fill out that 3115, you're going from an impermissible method of depreciation to a permissible method.
I mean, I've never heard of the IRS coming after somebody for not cost segregating and depreciating as much as they should, but it is true that if somebody should have been depreciating a property and then in turn they go to sell it, in theory, the IRS can reduce the basis and treat it as if they depreciate it like they were supposed to. So you're not, even though you think you might be doing the country a favor by not claiming the depreciation and paying more taxes, they'll still treat you like you have been depreciating it in the long run. I've never seen that happen, but that is in theory what the IRS can do.
Yeah, they charge you recapture tax when you sell a property, whether you've taken the depreciation or not. So you definitely want to take it for sure.
So I'm hearing that is our patriotic duty to take bonus depreciation.
Yes, absolutely.
There's the soundbite from the podcast. So, all right, let's wrap in what you were just describing to our real world situation that's happening literally right this second. Going back to the end of last year, where we sold that property, where we conducted a large cost segregation study on it in 2022, we decided to sell it. We had our agent Sean Bakhtiari here on Smart Stay Show a couple episodes ago, discussing why we sold it. So go back and listen to that one. But the reality is we sold it, right? And we didn't think we were going to sell it, but we ended up selling it. So now we have to pay all this capital gains on the property. Rory and I, during our long car rides, we were putting our heads together and we said, what are we missing? Like, is there anything that we're missing in our portfolio, our investments, in how we filed our taxes and our businesses, and I think Rory thought of our condo in Provincetown. Now we have this business, Pride Away Stays, in Provincetown, where we co-host at this point almost 30 properties on behalf of other people, second homeowners, investors. We too are one of those investors, and we purchased this property a number of years ago, and we have been doing straight line depreciation on this condo. We were thinking this could be a good candidate to help offset some of our tax liability from last year because, as we know, we can't depreciate land. So the condo doesn't have a ton of land, right? But where it is in a very, very expensive market makes the dwelling itself relatively expensive. So Rory, we just got this back from Erik before we hit record. It was a very well-timed email to us, giving a initial analysis as to what he thinks we could do and what the impact of the study would be. And Rory, what are your thoughts on what we're seeing now that we might be able to offset some of our capital gains with this poor man's reverse 1031 exchange or whatever it's called?
Well, I mean, Erik was kind of hinting at this, right? We didn't take the bonus depreciation back in 2018 when this was placed in service because at that time we didn't need the deduction. And now we do. So we have an opportunity to go back and reclaim it. So what I think is as a broader lesson for people is that if you do have a bit of a tax crisis, you can actually be creative and think, not only what did I do this year, but what are some of the things in prior years that I can go back and reclaim. And it's a little bit messier. We have the form 3115. It's not as simple as just putting it on this year's taxes with no changes. But if you do find yourself in this situation, or you feel like you missed the boat on the cost segregation and bonus depreciation, don't fear. There might be a way to go back and reclaim that deduction now.
And I think you hit it on the head. What you said, where I just want to double down on that, is that cost segregation is one of the very few tools that I'm aware of, or one of the few deductions that I'm aware of, that you can actually pick and choose when you utilize it. You guys didn't need to do this condo 3 years ago because you had enough deductions from other investments that you had made. So you don't do it. You just keep your cost seg study in your pocket. You just let it sit there until you need it. And you use it in a year where you have high income or not a lot of deductions. And so you want to use these cost segregation studies to manage your tax brackets. And I don't know of a lot of other tax planning tools. Like if you own a property and you decide to put a pool in it, you have to take those deductions of the pool cost in the year that you put the pool in. You can't say, I don't need those deductions this year, so I'm going to hold on to them for next year. They don't let you do that. You got to take them this year, and might drop you below zero, whatever. But cost segregation, again, is one of the few where you just keep it in your pocket. You don't have to. And we advise people all the time. People call me and say, hey, I bought a property. I need to do a cost seg study. And I'm like, all right, well, let's slow down a little bit. Like, what is your income for this year? Oh, I had all these renovations. I don't have to pay any taxes this year. I'm like, okay, so why are we doing a cost seg study? Like, let's not pay for a cost seg study this year just to create a large deduction. Now, the good news is it carries forward. You don't ever lose it. But I don't ever advise people that pay me money this year to then sit on this deduction that they can't use for 2 or 3 years because they've got all these other deductions or write-offs from other investment properties. So I just want to point that out because I think it's so important. You hit it on the head. It's a great tax planning tool. It's one of the best tax planning tools that I'm aware of.
Well, back in 2022, we did pay you and carried a lot forward too because we didn't use it all that year.
That's the problem with 100% bonuses. We create these deductions that people can't even use. So like I said, we're wiping out all types of income. So you can blame that on the government. That one wasn't on me.
Yeah. Hey, we're just following the rules.
Right.
In this situation, I'm kind of looking at the proposed schedule on my other screen that you've put forward. And basically, in the 39 and a half years, when you straight line depreciate something, for this property, we're taking roughly $8,800 a year in depreciation. With this study, pulling forward items into the 5, 7, and 15-year buckets, you're proposing that roughly $95,000 can get pulled forward, which makes the straight line depreciation all the way down 39 and a half years, about $6,400 per month. When you do that math and you're saving $2,200 a month over 39 and a half years, you multiply that out and that number all comes into the first year. I mean, that becomes a significant number that's north of $90,000, which is a number that we would like to take right now if we're entitled to do something like that. So, if you're listening to this and wondering if is this even worth it? Is it even worth restating, and saying, hey, IRS, I screwed up a couple of years ago. I'm going to have to file this massive form. In my mind, it is. Right. Again, we set this over to Erik. We planned this recording a number of weeks ago. We got him what he needed after he and his team bothered us a couple of times over the holidays, being like, where's your depreciation schedule? I'm like, I know, we got to get it over to you. So we got it over to you. You got this right back to us before the recording. And it was very timely. But in my mind, this is all worth it. This is worth doing, all day, every day, whenever you can. To your point though, if you have enough deductions, why bother doing it? It's just, you're going to go into the hole even more. This year, we'll see if we can get these projects off the ground, but we have ideas to reinvest in a couple of our properties, where we're going to make some significant capital improvements on those properties. So theoretically, we're going to have deductions, this coming year, if indeed we go ahead and do that. So the tactic that we have right now probably wouldn't be one we would need to do this year, but we need it from 2025 for tax plan. So this was a very good, timely discussion about a real world topic that's happening legitimately to us and apparently to hundreds of people who are ringing your phone off the hooks right now that we're at 100% bonus depreciation.
Yeah. No, it's a great time to be a real estate investor. Like I said, the tax laws are so favorable, so let's take advantage of them while we can.
So we'll put mavencostseg.com in the show notes here so people can go get a hold of Erik. We have a link for Erik also, so you can click on that link and we'll know that you heard it here on Smart Stay Show. Rory, any final thoughts for Erik while we have him?
I think we kind of went over a lot, and I don't. The point of this episode of this podcast isn't necessarily to overwhelm anybody who's listening to it, or to intimidate you with how much we know about cost segregation. It's just to make you aware that this is something that exists. So if you've put short-term rental in particular into service in the past couple of years, or you're thinking about doing this is a tool that really should be on your radar, and it's worth taking a moment, or it's worth talking to somebody to walk through the steps to see what you qualify for, because these are not just small impacts on your year-end taxes. These are kind of major transformational impacts on your taxes.
I think that's very important to understate or to underline. When I get the, hey, I want to pick your brain conversations from friends or family or neighbors, which happens all the time about short-term rentals, the conversation eventually comes down this road. And it's like light bulbs go off in who I'm talking to, because they want to talk about decor or market or what platforms to go on or how to price a property. They're usually not even thinking about this. And I think this is almost where you need to begin if you want to be a real estate investor. You have to kind of look at your holistic picture of all of your assets, figure how much money you're paying the government, how much money you're paying into your real estate assets, and see if there is a smarter, better way to position everything that you're doing using the tax code as it's written. And we're really grateful that we found you guys to help us navigate those choppy waters, Erik. So thank you so much for your work at Maven Cost Segregation and for being such an astute scholar in the space.
No, I thank you guys for the time and the opportunity. It's been great.
Awesome. Well, thank you for listening, and we'll see you on the next episode.